Let's look at variance analysis using standard costs. Variance analysis is the process of identifying and analyzing differences in actual costs versus standard costs. While the budget difference will show you that you were over or under budget, variance analysis helps you discover why. Wait, what is a standard cost? A standard cost is a per unit expectation set by management. Types of standards include materials quantity, materials price, labor quantity, and labor price. Standards should be rigorous yet attainable under normal operations. In addition, they should include allowances for waste, downtime, rest periods, and other similar activities. Using standards allows management to analyze the components of a cost to determine what caused that variance. Let's look at an example. Marionette Inc. has prepared the following standard cost sheet for one unit of its products. Listed here are the standards. These are what the budget is based on. Next, it says that during the month of April, the company manufactures 340 units and incurs the following costs. Therefore, these are our actual costs that we will use for analysis. First, let's look at our total labor variance, which is total costs less total standard costs. However, it's important for us to understand the components. Our actual costs are based on the manufacture of 340 units. So for our comparison, we need to keep that amount of finished units in mind. Now we can calculate our total actual costs as actual hours times actual rate. Note that since total costs were given, I had to calculate the actual rate, but this is important to have for future calculations. We can calculate our standard cost as standard hours times the standard rate. Note that our standard was 6 hours per unit, so to find our total standard, we had to multiply by the 340 finished units. Ultimately, we determined that the total variance is $64 unfavorable. Now that we have our total labor variance, we can use our data to separate the components for further analysis. We can calculate our labor quantity variance by multiplying the actual hours times the standard rate and comparing that to the standard cost. Note that our only variable then is the actual hours, and we can see that our total labor quantity variance is $480 unfavorable. Next, let's look at the labor price variance. On this variance, the variable that we isolate is the rates, while using actual hours for the calculations. Here we see that our labor price variance is $416 favorable. Let's review the labor variances. Our total labor variance was $64 unfavorable, and when we separated the variance into the quantity and the price variances, we noticed that the labor quantity was $480 unfavorable, but that it was offset by $416 favorable variance on the price or hourly wage rate that was incurred. Now let's go back to our problem and look at the materials variances, which is the total actual materials cost minus total standard materials cost. And again, we need to make sure that we are looking at the totals based on the 340 units of finished goods. We then can separate our actual materials cost into actual quantity times actual price. I again had to calculate the per unit price because that is what we use for our variance calculations. Then we separate our standard materials cost into standard quantity times standard price, and we can see that we have a $2,810 favorable variance. If we then want to separate the components, we can look at the materials quantity variance by isolating the quantity variable in comparison to standard price, and we will see that there was a $3,060 favorable variance on the quantity usage. To determine the materials price variance, we isolate the price variable against actual quantity, and we will see that they had a $250 unfavorable price variance. Here is a summary for the materials variances, which show that the total favorable materials variance consisted of a large favorable materials quantity variance and a small unfavorable materials price variance. Now that we have identified all of the variances for Marionette Inc.'s April production, managers of the company can be evaluated based on their effectiveness against the standards.